I want you to get out your investment statements and look at the different funds that you own. Do you own 5, 10, 15, 20 different funds that you have? You think you're diversified, right? Well, what if I told you that you absolutely could be wrong? And this mistake really could cost you a secure retirement in the next market crash that we have. Today what I'm going to do is I'm going to show you a hidden risk that could be lurking in your portfolio right now, a risk that most investors really don't discover until they've already seen their portfolio go down by 20, 30, maybe even 40%. That risk to me right now is probably one of the highest that I have seen in the past 25 years that I have been in the business. And by the end of this segment, what I want you to do is I want you to know exactly how to check to see if you're exposed. And I'm going to give you 3 key strategies to help you keep moving forward. So again, here's the thing. You think you're diversified, you own different investments, you look at your statements, you split your money up amongst different funds. You're not putting all your eggs in one basket, but what if nobody told you that all of those baskets ended up owning the same thing? And that when the economy crashes, it doesn't matter how many baskets that you had. And what this is called portfolio overlap. And it could be a silent killer inside of your retirement plan right now. So what portfolio overlap is ultimately when you have multiple investments in your portfolio, but they have relatively all of the same or highly correlated underlying assets. So, in plain English, you think you own different investments, but you actually own the same companies over and over again. I'll give you a real-world example. So say you own an S&P 500 index fund. Maybe you own a large-cap growth ETF. Maybe you own a technology sector fund, and maybe you own the NASDAQ 100 fund as well. Well, congratulations. What you did is you just bought Apple, Microsoft, NVIDIA, 4 separate times, and you end up with very little diversification. Now, those could be great companies to own, and they're in some of our portfolios that we have as well. But why this matters right now is in 2025, if you take the S&P 500 index and you look at the top 7 companies, they make up 34% of the entire stock market index. And what that means is that owning multiple funds that track or follow the S&P 500 index, you're massively overweight in a few tech companies. And the rally has been great here in 2025. It was great in 2024, even great in 2023. But the problem is when tech has a bad day, your diversified portfolio, it can crash kind of altogether. And there's 3 different ways that this overlap can hurt you. Number 1 is the diversification illusion. I can go back in time and I could think about back in 1999, and if we could go back to 1999, it was a pretty great year. I remember my wife and I were, young kids in our career, and things were great. Life was good. And, what we had is in 2000, you had a dot-com bubble burst. So technology blew up, the market started to collapse, and things really got into trouble. And that's in that environment where also this diversification illusion, caught a lot of investors off guard. They thought they were diversified. They might have owned 5, again, 10, maybe even more funds. You feel safe. You feel smart. You feel you're diversified. But, looking at the technology bubble burst of the 2000 environment, if you dig deeper, what you discover is that 70, 80, even 90% sometimes of the holdings were the same in multiple different investment companies. So again, if you bought the S&P 500 index or you also own the total stock market fund, those 2 funds have about an 82% overlap. Essentially, you bought the same portfolio twice. So that illusion of diversification is actually worse when you know that you're heavily concentrated because you're taking a concentrated risk on just a small group of companies. Number 2 is you have amplified volatility. Going to Cedar Point or going on roller coaster rides, that typically is fun stuff for young kids. But in retirement time, I think a lot of us tend to prefer more of a smoother ride. But The reason number two, the amplified volatility kicks in is because it can get very painful when you have massive overlap and you're concentrating your exposure to specific sectors, in this example like technology, without realizing how much exposure that you have. Your portfolio can become way more volatile than you think. You might believe you're in a moderate, say 60-40 allocation portfolio, but because of the overlap that you have, you could be aggressively 80% tech heavy. And when the tech sells off, hold on to your hat because everything you own could all start going down. And there could be no cushion, no safety net, just pure undiversified pain. And the analogy of just let it ride doesn't typically work well when you're close to and or in retirement time. The risk number three is, are you taking the right amount of risk in your portfolio? You probably filled out some type of risk questionnaire when you met with your advisor or when you set up your brokerage account, and they probably went through a series of questions asking you if you were a conservative, a moderate, or an aggressive investor. And, without even knowing you, I would venture to say that most likely it's one of two scenarios. You most likely would say, well, I'm a moderate investor. Or scenario number two is maybe you tend to be a little bit more aggressive one and your spouse tends to be more conservative. So when you blend it out, you still end up in a moderate type situation. Well, here's the problem with that. Your definition of moderate and your investment company's definition of moderate could be absolutely different. And it's not until something bad happens in the stock market that you realize that your definition of a moderate level risk versus their definition could be completely different. And the way that you figure that out is you take and you analyze your portfolio and you develop what your overall risk score is and what your risk number is. So there's software out there. You can use Morningstar. We use that software. We also use software called Riskalyze. And what it does is it allows you to stress test your portfolio. It allows you to measure how much overlap you have in your portfolio so you can see what are the investments that all own the same thing. If and when the market started to go down, what could be the overall drawdown that you have in the portfolio. And do that now while things are good. The market's good. Things are healthy. You're looking at your statements. Things are running good. Run the fire safety drill now. So here's what I want you to do, and here's the solutions. Number one is I want you to audit your portfolio. And, in auditing your portfolio, you're really going to find out exactly what you own. There's several free tools that are available out there. Like I mentioned, Morningstar has some. You can upload your holdings. That'll show you your true exposure that you have to sectors, companies, regions. To me, Morningstar is just a great tool to utilize. There's Portfolio Visualizer. It's great for seeing correlation between your funds. If you're working with an advisor or if you have an online dashboard with the investment company that you work with, most of these companies are going to have built-in overlap checkers. You want to make sure that you use those. Spend 20 minutes to do that exercise, and it might surprise you how much overlap that you have. Number two, diversify with an equal weight type portfolio. Here's to me what true diversification really means. It's not just a collection of getting more and more funds that own the same stuff. I recommend that oftentimes you try to equal weight your equity positions. There's mutual funds, there's ETFs, there's ways that you can do this on owning your own stocks where you can give roughly the same weight to each company. As an example, let's say you owned 100 stocks. You would put the same $1 investment on each of the 100 stocks. And doing so will then help prevent that, large concentration that you see with just a small select group of stocks. So you're going to end up eliminating or reducing some of that single or limited stock concentration risk. You could have an ETF if you own funds that could be rebalanced over time, helping you stick with that diversified investment approach. It can help you avoid having that technology.com bubble burst like what we saw in the 2000s. So the plan is to, again, audit your portfolio, identify your overlap, do your research about equal weight investments, and set up a reoccurring calendar to check for overlap every 6 to 12 months. And don't wait for the next stock market crash to discover that your diversified portfolio really is not diversified. Now's the time to fix this while the markets are at record high. If you want to dive deeper into this conversation, you're like, Nolan, I get it. I just don't know how to do this on my own. You can get a hold of us. We'll do an independent portfolio analysis. We can put this stuff in Morningstar. We can put this stuff in Risk Alliance. We can give you a report and give you feedback on how concentrated this risk is in your portfolio. We can help you run that fire safety drill and kind of go through showing you what that looks like as well. Or if you want to learn more about what our philosophy, just Google the independent income system, and that is our approach for helping you develop a secure retirement.